Welcome to this very special conversation. I want to start off by wishing you a very Merry Christmas and a Happy New Year to everybody at home. It's a good time, of course, to reset, to sit back this weekend and think about your finances and how you want to approach the new year that is going to be both a challenging and an interesting one. Nilesh, Merry Christmas to you and
Merry
Happy New
Christmas
Year.
to you and Happy New Year to your viewers.
It is going to be a challenging year. I don't think we can now sort of argue about the fact that the next 2 quarters are going to be tough 2 quarters.
Yes.
Is this also, and I want to start off with a straight up question, and the reason why I insisted that we do this interview this weekend is because for any regular investor like myself, a salaried person who puts their money away, what demonetization is effectively meant at the bottom of the page is that real estate prices have come down. So any home that I'm paying a home loan on, the value of that has come down officially. We know fixed deposit rates have come down. The market has corrected. Gold has come down drastically. So all forms of investment have taken a hit. Effectively, my net worth has come down by 20% or so. How do I deal with that as an average Indian?
So, many a times if you see people who do long jump, they actually take 1 or 2 steps back and then build momentum by running. Many times it's important to drive the car in reverse gear before you can come out of parking lot and pick up the speed. Of course, when you are in parking lot, you are very stable. You don't have to worry about volatility. But if you want to gain momentum, you have no option but to do a little bit forward, reverse, forward, reverse.
So you believe that this is a step back to gain momentum. You don't believe that this is actually a hurdle that we all tripped on after we had gained momentum.
So is there a short-term pain? There's no doubt about it. Has consumption been affected? The answer is yes. Is small and medium enterprises suffering? The answer is yes. Even the Prime Minister is saying that for first 50 days, please accept the pain.
50 days are almost over.
50 days are about to get over, and to that extent, pain is also receding. The currency in circulation is now crossing 5 lakh crore plus, which is fairly large, and already you have about 3.5 lakh crore of smaller denomination notes in the system. So that's almost 8.5 lakh crore.
While that is fair, we are currently in a situation now where our fixed deposit rates have gone down. And I'm speaking purely as a salaried investor. Our fixed deposit rates have gone down, but our loan rates have not. So we're actually paying the same amount on our home loans, but we're getting lower and lower on our fixed deposits. And as a result, on our debt funds and all of our EPF rates have come down. So where is the sense in this? And all the greater good be set aside for the time being. I want to focus on individual portfolios. Where is the sense in my individual portfolio right now? What do you see in the next 1 year?
So the guy who bought gold at 55,000 rupee when the price was 30,000 rupee on 9th November night or 8th November night, they are not complaining for their foolhardiness. They are not blaming government for doing that stupidity. Now EPFO rates have come down, but don't real interest rate matter? If inflation was 10% and EPFO was giving 9%, people were fine. When inflation is 4% and EPFO instead of 8.8 is giving 8.65, people are complaining. Wake up. You have to compare real interest rates, not nominal interest rates.
So then where is the argument on where our lending rates are still?
So will lending rates comes down? Answer is yes. Undoubtedly it will come down. Is it coming at the same speed as one is expecting? Probably there is a little bit of time lag.
Okay, so tell me where you see, and I'll make the question specific now, where do you see the December quarter and the quarter after that? Where do you see the corporate numbers and how will the market react to those corporate
December
numbers?
quarter numbers still will not have full blunt of demonetization because post-November in certain segments there was huge selling. Like
also Diwali gets counted in the December quarter. Absolutely. And we had a good Diwali as a country.
So December I'm not too worried. It's not going to show me the real impact. And the March quarter will depend upon what kind of support we can get out of the budget. If budget changes the sentiment by one, increasing tax exemptions, improving the minimum tax limits, cutting some slabs on taxation side, giving some infrastructure spending, then their promptness, their support could pull economy out of this, little bit of patch of slowdown.
Do you believe the government's balance sheet, which is effectively the deficit that we all watch out for, the government's balance sheet has the depth right now, given the effects of demonetization, to be able to do all of the things you just
So
said on
government
taxes?
of India is hugely asset rich,
Okay.
but they are liquidity poor. The amount of land holding which government of India possesses is unbelievable. Railway itself has identified $40 billion worth of land, which they can monetize.
Well, they haven't.
They haven't.
They haven't.
There are so many PSUs which are shut, but which are sitting on huge amount of real estate. Now, can we monetize those assets? Clearly, government is asset rich. It's not that they are bankrupt. If we increase the divestment, if we monetize our excess land holding, if we monetize some of the assets which government is owning in soft or hard parts, combination of that can create the resources which is necessary for giving tax exemptions so that consumer sentiment improves, and also spend on infrastructure. My guess is that now government will take those hard decisions.
Right. I always ask you this question. I'm a 50-year-old individual, salaried. I walk into your office with 100 rupees. Do my asset allocation right now on this 100 rupees, assuming I'm going to retire in 10 years, have your answers changed given what we're looking at over the next year or so?
My answer has little bit changed from fixed income allocation to equity allocation. I'll recommend that 50-year average risk taker or risk averse customer. Theoretically, you should put 50% in risky assets and 50% in non-risky assets. But looking at today's condition, I'll put 60% in risky assets like equities, real estate, and 40% in non-risky assets like fixed income.
So you would buy real estate in this market?
I will buy real estate in those areas, in those places where I see demand coming up. Banks will be flush with liquidity. They are not going to go to institutional lending, wholesale lending. They are going to go to retail lending. To the customers whom they are going to provide next housing loan, where will those customers go and buy real estate? It will be an affordable segment. It will be in lower end of luxury segment. It will be on the outskirts of city. It will be in those areas where jobs are getting developed. So if you can focus on buying real estate in that area, I think you will make money over there also.
Would you recommend that same 50-year-old, the equity that you recommended be balanced equity, in balanced funds? Would you recommend aggressive equity in this market right now?
I will recommend aggressive equity also in certain quantum, but not through a lump sum investments, through a SIP or STP kind of investment.
Well, the other group of people I'm really concerned about at this point are those who rely on their deposit returns for income. Senior citizens, for example, who extensively use fixed deposits and maybe some debt funds in order to generate a regular income. They are now faced with a world where that income is going to be drastically lower than what they are used to. What is your advice to them on how they should adjust to this new normal?
Now, people who have only invested into fixed deposits, my recommendation to them will be to wake up. They need to follow financial rules like asset allocation, like regular investment, to move from pure fixed income to hybrid model. They'll have to take some exposure on equity. They'll have to take some exposure in commercial real estate if they can afford to, or alternative investments like real estate investment trust or real estate PMSs, which allows them to take exposure on real estate without committing large sums of money.
But technically, none of those things are actually available to the average investor just yet. Even when the real estate investment trust comes, it will have a very high entry barrier. So a normal retired person, for example, won't be able to access it.
So if you are in that category, which is way below where this threshold limits are, you have certain senior citizens related schemes offered by Government of India, which still provides a very high rate of interest, I believe 9.5% for few 10 lakh or 15 lakh kind of money. So first grab that and complete that. That will ensure you some amount of money. Beyond that, you will have to take the market risk. When people invest in bank fixed deposits, they don't realize that it is one of the riskiest form of investment, not from a credit point of view, but from a reinvestment point of view. When I started my career, 20% and 18% on fixed deposit was possible. Then it became 15 and 16, then it became 13 and 14, then it became 10. Today it is already 6 and 7. Now, over years you have seen interest rates coming down on bank fixed deposits. If you didn't accept that reinvestment risk, bad luck to you.
It's also fair to assume that when the yields come down over a period of time, while the short-term bond funds will benefit for a while, over a period of time they will also settle closer to whatever the
on a longer-term basis. My returns are going to come from coupon majority, and of course I will try to do value add by trading my portfolio and making some capital appreciation. But
so your advice is equity and real estate is important now in all portfolios. You can't avoid it anymore.
You know, our commonsensical thing is don't put all eggs in one basket. It applies as much to investment as it applies in real life.
How would you advise the average Indian to battle the temporary, although it is temporary, the feel poor factor that they're feeling? And I'm not talking about the cash in their pocket. I'm talking about the impact on their general portfolios, on their net worth. How do we keep our eye on the long-term price?
Oh, they should simply go back to 1990 and see how a blue chip stock like HDFC has delivered a great return and how they missed out. They should fast forward it to 2016 and say that, okay, I made the mistake of not investing in that blue chip stock in those days, which I could have. But fair enough, now let me not repeat the same mistake in 2016. I still have chances to recover. Between 1991 and 2016, I think Indian GDP has expanded from $250 billion or $275 billion to $2 trillion. Now, most people are expecting India to double its GDP over next 7 to 12 or 13 years. Now, over next 12 years, we have same ability to create India which we have created over last 25 years. So you haven't lost out on anything. All the opportunities which you missed between 91 to 2016 is going to come to you from 2017 to maybe 2030. It's still there. Don't repeat the mistake of not investing sufficiently and adequately into the blue chip companies of India which you made in 1990.
Okay. The other sector we must talk about is the banking sector. A lot of your funds hold HDFC Bank, hold a lot of the banking stocks in those funds. When demonetization announcements first came out, like you rightfully said, there was this expectation that cash will flow into the banking sector. The banking sector benefited as far as the stock market was concerned. Now there have been reports about the fact that close to 7 lakh crore rupees of debt is being held in risky businesses, and that's caused some damage to the sentiment on banking stocks. I want you to help our viewers understand if the banking sector is at any sort of risk, in your opinion.
In the banking sector, there is always the risk of NPA. But as long as you can manage that risk for which you are getting adequate compensation, you can still create value for your shareholders. I don't think Indian banking system is today at a higher risk than what it was on 8th of November.
Okay.
Temporarily, will there be a rise in NPAs because of some issues at microfinance level, some issues at SME level? The answer is yes. But this is
so basically what this is there will be some businesses who will be unable to pay their money back or to pay the interest on their loans temporarily because of the impact of demonetization.
Absolutely.
You believe our banking system can handle that pressure?
Of course.
When you look at the market right now, and you said that you are seeing value, which is why you're buying. Where are you seeing value? Which sectors do you see value in? Because if the larger messages are to be believed, almost all sectors are suffering right now. So
Yes.
where are you seeing the value in these sectors?
So there is one big theme coming out of demonetization. It is shift from unorganized to organized. In India, by virtue of past, we have created a unorganized sector which most of the time is competing on the basis of tax arbitrage. They don't pay appropriate share of tax, and that's how they are competitive. Now with demonetization and GST, a lot of those unorganized sectors will suffer. Businesses will move to organized sector. They will gain on efficiency, they'll gain on productivity. So this is one big shift happening, and across sector, be it FMCG, be it consumer durables, be it auto components, be it retailing, be it textiles. In all those segments where organized sector will benefit from unorganized sector, this is one trend to play. Banking services, not the NBFC variety but the pure bank variety, we believe will benefit tremendously from the shift of tijori money coming into bank account and people adopting digital technology. We also believe there is reasonable opportunity in pharma space, provided you can catch the falling knife. the sector will underperform for next 6 to 10, 12 months. But if you can average yourself in, there's an opportunity at the end of the 12-month period. We also believe some of the consumer stock, which are today coming down because of demonetization related slowdown, provides great opportunity for next 3, 4, 5 years.
Would it be fair to then also assume that anyone who's getting into equity right now should have a minimum 4-5 year horizon, because you kept saying for the next 4-5 years, for the next 4-5 years. So anything less than that should actually not be even trying this market out.
If you are not having 4-5 year horizon, then you should be extremely lucky to invest in equity. As I mentioned earlier, your 1 year holding period return of fixed deposit will be less than 1 day's return of a good stock. If you are lucky, you will make that return in 1 day.
If you're
but
unlucky,
in my experience, most people don't know which stock is that and on which day is that. So you have no option but to give longer term outlook, longer term time horizon to your portfolio. So unless until you are extremely lucky, please have 4 to 5 year horizon.
The other sector I must ask you about is, of course, you kept saying it's a good time to buy real estate. You had an argument saying interest rates will come down, banks will lend, people will have to buy. So for people looking at stocks at this point, would you recommend construction, real estate and allied sectors? Because there's been a certain like doom and gloom being written about these sectors.
Sure. So I'll push allied sector first rather than the real estate. In the real estate, there are issues related to governance. How many people sell in pure white, how many people put black into it, and God
And there's
knows.
a regulator coming now that might change the dynamic of that entire sector.
When it changes, we'll accept it. As of today, I will give benefit of doubt to myself rather than to the real estate developer. And there are better ways to play this real estate cycle. I'll rather play this through allied sectors like cement, furniture and fixture, electrical appliances, consumer white goods, and the people who finance real estate acquisition. So my recommendation is that do play for real estate revival after a gap of 6 to 18 months when banks will, push housing loans, but play it via the allied sectors rather than the frontline real estate.
Why the paints and the bathroom fittings and not actually
Absolutely.
the guys who are building?
Absolutely.
Right. Okay. Building the house. I want to ask you about a couple of your funds that I track quite closely. The Kotak Select Focus is still doing really well. In this market, is that the kind of fund to rely on and run with? Because in a market like this that is swaying, one of the characteristics of the swaying is that it tends to beat up the banking sector on the way out this side and the infrastructure on the way out that side. So there are different sectors being picked on every day and being beaten up every day. So a diversified equity fund, is that the way to go then?
Yes. I mean, clearly there are various steps to climb on an investment scale, and Kotak Select Focus continues to be one entry level fund. If I can just take the liberty of dividing Indian cuisine in two parts, North Indian cuisine and South Indian cuisine, North Indian being mid and small cap and South Indian being large cap, Kotak Select Focus is combination of North and South Indian cuisine. Kotak 50 is South Indian cuisine, Kotak Emerging Equity is North Indian cuisine. So my request to investors will be, first take a Select Focus kind of blend fund of large and mid cap. Once you are satisfied, then you can move towards Kotak 50 or Kotak Emerging Equity, which is giving you exposure to mid cap or large cap.
Well, works in investment is not a very appetizing meal to be having all of it at the same time. I also have to ask you about the Kotak Asset Allocation Fund. It was launched in 2013. It's at 29 crore rupees assets under management. It was a very tiny fund. But again, in this market, for people who are conservative, for people who don't want to take risk, is this the kind of fund to enter then? Explain to me why the fund hasn't grown larger.
Sure.
And tell me if you think it's
my
the fund
boss
to use.
tells me that it is my effort which has not made this fund grow, and I replied to him saying that no sir, it is your mistake in not pursuing government to give this fund a status of equity fund based on its underlying allocation. So clearly this fund is at a disadvantage
because it's a fund of funds,
it's a fund of
and it
fund.
doesn't get the advantage.
But if you see the asset allocation which we have done between gold, equity and debt, I think we have created a fantastic track record. The day this tax arbitrage goes away, my feeling is that Kotak Asset Allocation kind of fund will be the future of fund industry, where customers will come for a solution, not for investment. He will say, look, if you are the fund managers who give all the gyan about managing money and doing asset allocation, give me a fund where you can do it actually. And that's where I will become answerable, other than from providing gyan, actually providing asset allocation.
A couple of years ago when we talked, you said, if you love your country, you won't buy gold. We are now in a world where let's accept the fact that the bad apples who were in corruption and black money will continue to remain in corruption and black money. They're now using gold instead of using cash. Have we set ourselves back 5 years in the campaign to get Indians to stop using gold because it's bad for the country?
That fear is there. Will gold replace currency as a means of corruption? But clearly there is equally bright spot. One, the level of corruption is coming down.
We conclusively say the level of corruption is coming down.
We can't say it conclusively, but today when we meet industrialists and businessmen, certainly at the central level they are saying that there is less corruption, or the corruption has come down dramatically. No one is saying that corruption has actually gone up. Now, as a country, we can't move from fifth gear of corruption to reverse gear of corruption overnight. We still have to go from fifth to fourth, fourth to third, third to second, second to one, and one to reverse. So for us to reach that Scandinavian level of corruption, it will take time. But it's not something which will not happen. There was a conclusive, there was a research done, or there was a thing done by one institute, which I forget who it was, but Mumbai was the second best city in terms of returning empty pockets.
Yes.
And we were ahead of many other countries and many other states, cities which were more richer than us. So clearly there is one segment of India where corruption is not there, where honesty is still prevailing. So my guess is that hopefully gold will not come back as a medium of corruption. Lower gold prices have also given jolt to investors. And a lot of people who rushed to buy gold on 8th of November, 9th of November and bought gold at much, much higher premium to prevailing prices, today have realized the stupidity of their decision. The gold prices in rupee terms are at 27,000. You put 10% import duty, realizable term, they are probably at 25,000, and you are still holding black assets in your portfolio. It makes much more sense for you to declare your income in Pradhan Mantri Garib Kalyan Yojana, pay 50% tax, and put balance 50% in rewarding instruments like equity. That will deliver far better return than buying gold.
My last question to you as we get into the new year, is there one message that you want to give average salaried Indians who use SIPs and who pay loans and invest on a monthly basis?
So one, we have always been told that money is not important in life. Don't run after money. My message to investor is that yes, that's true, but make sure that you have made such statement after you have made enough money, not before you have made enough money. As salaried employees, all of us work 24/7 for our job. We must take out some time out of that to take care of our wealth, because over a period of time, that wealth taken good care will deliver more return than your salary. It will give you financial independence. It doesn't mean that you have to quit your job, but given an option, you will be able to quit your job earlier than what you are planning if you have taken good care of your wealth.
So if you take good care of your wealth, you'll allow yourself the choice to quit your job if you want to.
Absolutely.
Many thanks for spending time with us and answering all of our questions. I wish you a happy new year and a prosperous new year for all of us.
Same to you. Happy and prosperous both go together.
Thank you.